Hello, I'm Abhilash Narayan, investment strategist at HSBC. Welcome to the latest edition of India Brief, where we discuss our house views about Indian equities and fixed income markets. After an eventful August which saw the imposition of 50% US trade tariffs, September was marked by signs of progress in trade talks between India and US and the finalization of the GST overhaul, which should result in a boost to domestic consumption. In the near term, stronger domestic consumption and some statistical factors lead us to believe that GDP growth could surprise to the upside. Hence, we have revised our 2025 GDP growth forecast to 7.2% and 2026 forecast to 6.3%. Following the latest RBI meeting, where the central bank released its revised inflation projections, we now expect 0.25% rate cut in the December Monetary Policy Committee meeting, which should bring the repo rate down to 5.25%. The RBI governor also announced a slew of measures to support the banking system, increase credit offtake, simplify foreign exchange management, and promote the internationalization of rupee, all of which should result in stronger credit growth in the medium term. So, what does all of this mean for financial markets? Well, firstly, we are bullish on Indian local currency bonds. We view the current level of yields as an attractive entry point, and we expect that benchmark 10-year yields to come down over the next few months due to a combination of easing concerns about supply, robust domestic demand, RBI rate cuts, as well as potential resumption of international flows. However, we remain neutral on Indian equities as we believe that the upside and downside risks are largely balanced. While India's GDP growth continues to be robust, earnings are a drag for Indian equities in our opinion. We see risks of downward revision of 2026 consensus earnings forecasts from current levels. When we combine this with the still elevated valuations and mixed investor flows, we struggle to see any catalyst that would suggest outperformance of Indian equities versus regional or global peers. Within Indian equities, we have a preference for large cap stocks, especially as mid cap stocks are starting to screen as increasingly expensive. Considering the expected softness in earnings, we continue to prefer more domestically oriented sectors, which should benefit from the GST rate cuts. We are overweight on consumer discretionary, financials, industrials, and healthcare sector.